If you own a rent-controlled property in Washington, D.C., the official numbers for 2025 are now set. The Rental Housing Commission has issued the 2025 CPI and COLA, or Cost of Living Adjustment Notice, effective May 1st. For most rent-controlled units, the maximum allowable rent increase is 4.8%. That number comes directly from the notice. It's based on the 2.8% CPIW increase, 8% CPIW increase, plus the additional 2% allowed by the statute. For elderly or disabled tenants, the cap is 2.5% based on the Social Security COLA. Again, this is not opinion. This comes straight from the 2025 Rental Housing Commission CPI and COLA notice. Now, here's the problem. Your expenses did not rise at 4.8%. Water and sewer rates increased. Property taxes rose with assessments. Insurance premiums jumped, often 20% or more. So if your operating expense went up 10%, but your rent capped at 4.8%, you're losing ground. Not hypothetically, not emotionally, mathematically. And that brings us to the most misunderstood part of DC rent control. Because today I'm going to show you the only legal mechanism in DC that allows rent increase above the annual cap, the hardship petition. Now, let's talk about the law itself. Under DC Code 423502.12, housing providers are legally entitled to a 12% rate of return on equity, not revenue, not gross rent, equity. If your property is earning less than 12%, the rental administrator must allow a rent increase above the annual cap. This is not optional, it's not discretionary, it is statutory math. And the rule applies in 2026 and beyond. The CPI cap changes every year. The hardship formula does not. Here's the exact formula the city uses. Step 1, calculate the net income. That means the maximum legal rent minus allowable operating expenses. Not what you actually collected, what the law says you are entitled to collect. Step 2, calculate equity. That is assessed value of the property minus all the loans and the encumbrances. Principal balance count, interest does not. Line of credit count. Step 3, divide net income by equity. If the result is less than 12%, you qualify for a hardship increase. That single calculator controls everything. Now, here's where most hardship petitions fail. It's not the math, it's not the expenses. DC is very specific about what counts and what does not. Allowed expenses include water, sewer, property tax, insurance, management fee, routine maintenance, repairs, paint. Not allowed, mortgage principal payments, capital improvements, new roof, major system replacement. Those fall under a different petition. And here's the rule that kills most filings. You need 12 months of clean documentation, invoices, receipts, cancel checks. If you paid someone in cash and there's no paper trail, that expense is zero in the eyes of RAD, or Rental Accommodation Division audit. Now let's talk about risk, because filing a hardship petition automatically triggers an audit. RAD will review unit registration, business license statuses, rental filings, compliance history. So if you have unregistered units, if you missed a BBL renewal, if something wasn't filed correctly in a prior year, do not file yet. They will find it. And instead of approving a rent increase, they will issue fines and penalties. Every hardship petition starts with a clean hands review. Now, here's the part most landlords never consider. A hardship petition does not just affect your income. It affects your property value. Because multifamily property in DC is not valued emotionally, it's valued mathematically. Buyers don't pay for potential. They pay for the actual legal rent rolls, which means two identical buildings on the same block can sell for very different prices based solely on whether the rents are legally maximized or suppressed under rent control. Here is why. Small and large multifamily properties are typically valued using a capitalization rate. Very simple. Property value equals net operating income divided by cap rate. So when you increase rents legally through a hardship petition, you're permanently increasing the net operating income. And that increase gets capitalized into the sale price. Let's look at a conservative example. Say a hardship petition allows you to increase total building rent by $1,000 per month. That's $12,000 per year in additional net income. Small DC multifamily properties often trade at cap rate between 5 and 6%. At a 5% cap rate, that $12,000 supports roughly $250,000 in additional property value. Same building, same location, different rent roll. Now look at the other side. A property stuck under rent control with no approved hardship increase will not sell for the same amount. Buyers discount those buildings because future rent growth is capped, expenses are rising, and hardship risk transfers to them. That discount shows up directly into your sale every time. So when an owner says, I don't want to deal with a hardship petition, what they're really saying is, I am willing to accept a lower exit value to avoid paperwork. Most owners don't realize that until they're already selling. This is why hardship petitions are not just an income strategy. They are equity strategy. They protect your cash flow today, your financing option tomorrow, and your resale value when you exit. Before you do anything else, you need clean numbers. That's why I'm giving you a free Excel rent roll template designed specifically for DC hardship petitions. It helps you organize rents, units, and income the way RAD actually reviews them. So you can see on paper whether a hardship filing even makes sense. You can download the template using the link below. And if you own a multi-unit property in Washington, DC, I also invite you to join our exclusive private Facebook group for DC multi-unit landlords only. Both links are below.